Second quarter earnings season continues to rattle away with some big reports still coming in this past week from very popular stocks including Disney, Alibaba, Palantir, and more. So in today's video, we're going to run through some of the biggest reports from this week. I'll give you my quick opinion on each stock, let you know how the market reacted to those earnings reports, and I'll even let you know if I consider any of these stocks to be a buy now after their earnings. So it's going to be a ton of fun. I hope you enjoy the video, and if you're enjoying the channel, please subscribe. It really helps keep this channel alive. It means a lot to me. But with all that said, let's go ahead and jump straight into these earnings. Alright, now as per usual, we'll be going in chronological order here, and I pulled up a few of the most popular stocks that I usually get asked about, many of which I own myself too, so we try to cover them more on the channel. But this week, that'll include Palantir, Beyond Meat, and Tyson Foods, all reporting on Monday. Then we have Duolingo, who reported on Tuesday. We'll cover Disney, who reported on Wednesday, and then we'll finish up with Alibaba, who reported on Thursday. But starting first here with Monday, we had a very popular AI data management specialist report in Palantir, ticker symbol PLTR, who actually plummeted by over 15% this week following what I actually thought was a pretty damn good earnings report. And so, in my opinion, that pullback really had a lot to do with just how high the stock was already trading going into it, as it is still up by about 140% this year, even after this week's dip. So don't let the bears trick you into thinking that this is some kind of trash stock. Palantir has actually been on absolute fire lately, and this latest quarter was no exception, as they only very slightly missed expectations. You really shouldn't even count that at less than 1%, but revenues actually soared another 12% year over year, while net income more than doubled in size. And that's a huge deal, guys, because Palantir relies on both government and commercial contracts from businesses. So to still be growing during a weak economy where companies and governments are tightening their budgets and trying to spend less, it just shows how impressive and in high demand Palantir services are. In fact, their customer count grew by almost 40% year over year, as they added another 66 new deals worth over $1 million each, 30 of which, by the way, are worth over $5 million, and 18 are worth over $10 million. A few of those customers also spoke recently about how much they benefit from Palantir services, with Panasonic saying that their tools help them lower 4-hour processes down to 15 minutes. JD Power noted how fast Palantir's new AIP platform helped them build a large language model application in just a matter of days, which is really good because LLMs are kind of a mega trend right now in AI. And the biotech giant Novartis also talked about how Palantir helped them create an integrated data lake that accelerates their AI within the company and keeps all of their data organized and makes it easier to find new pharmaceutical discoveries at a faster rate. So Palantir is really helping all these businesses just run more efficiently, run faster and better, and especially with AI too. Even the military is still spending on Palantir services, with another $500 million contract awarded in May to help the US Special Operations Command with their AI Mission Command platform. Another big concern from the bears has always been a lack of profitability, but Palantir's latest quarter marked the third one in a row of GAAP profitability, while also maintaining their very high adjusted gross margins of above 80%. So it's really only a matter of time until we see these software-like margins scale up into their GAAP numbers too. And that's why you see such a high current valuation of a 67 PE and 16 PS ratio, but on a more future-looking PEG ratio, price to earnings to growth ratio, it's very cheap at just around 1. Again, it's not a currently cheap stock by today's numbers, and that's why it remains speculative and higher risk, but I think long term it's going to be a solid winner. And while I already bought heavily into the stock when it was down, I still plan on holding my shares well into retirement, and I think any kind of significant dips like the one that we're kind of going through right now will be considered buying opportunities in the future, because I still feel that they have a really big ceiling long term. Next up, though, the meat alternatives company Beyond Meat also reported on Monday, but they had a terrible showing, not only missing on both the top and bottom line, but also having their sales plummet by over 30% year over year in what is looking more and more like a very volatile meat alternatives market. In fact, US meat alternative retail sales have now fallen by 20%, just broadly speaking, so far this year. And as a result, Beyond stock fell by close to 20% this week too, and is now trading for just $13 a share. Guys, this is a stock that used to be worth well over $200, but has now crashed by almost 95% from its all-time high. That's really bad. Now, some people are saying to buy the dip because it's too low at these prices, and to be fair, I do think that there will always be vegetarian and vegan demand for their products, which is a market that is supposed to be growing at over 30% a year through the next decade. So perhaps the stock is a bit oversold at this point, as Beyond is one of the leaders in the space with a market cap of less than just $1 billion. And so all you really need to do is wait for their macro environment to improve. However, when I look at their financials and how much they bleed money every single year without even a ton of revenue growth to show for it, and the fact that their valuation is still pretty darn expensive even after a complete crash in the stock price, with a PEG above 40 and a price to sales still above 2, which is more than double the sector median, well, I just can't see why I would want to take the risk on a stock like this when I could just buy Tyson Foods stock instead, who happened to also report this past week. Now, to be clear, Tyson actually also had a horrible earnings report this past week for the second quarter, which we'll dive into in just a second. But at least unlike Beyond, that just sells meat alternatives, Tyson sells both that as well as real meat and poultry, where they're actually a world leader, and that's led to very strong financials over the years. They are, however, going through a big downturn right now, though, missing analyst estimates on both the top and bottom line for this last quarter, while also experiencing declines year over year. In fact, things are so bad right now that in the prior quarter, the CEO noted that he had never seen such a highly unusual situation where all of their meat segments were in decline. And this downturn continues to punish the stock, sending it falling another 2% this past week and down close to half its value from the top. The thing about Tyson, though, is that this is a very cyclical market that they operate in, and that's why the stock is often up and down by huge amounts. But the whole point about these type of stocks is that you're supposed to buy them when they're actually down, not when they're up. And right now happens to be one of those, one of the biggest downturns that I've ever seen in it, which not only leaves it at a price to sales ratio of just 0.3, which is like 70% cheaper than the sector, despite this being a market leader, but it's also raised their dividend yield to the highest levels that I've ever seen too. And it still has some really good growth metrics on that dividend too, like a tiny payout ratio and both a double-digit growth rate and growth history as well. Add it all up, and I'd much rather be buying Tyson Foods at today's prices. I think it's a lot safer long-term, and to sum up my feelings about it, I'll quote the CEO's newest comments from this quarter where he said, "We've been through market cycles before, and I'm confident that we have the right strategy, seasoned leadership, and team members in place to emerge strong from this one too." And I agree. I want an experienced leader here in this horrible environment, not a speculative high risk one. So I'll take Tyson over Beyond. Okay, moving on to Tuesday though, the fairly popular spec stock Duolingo had an excellent showing, at least in my opinion, which continued their red hot streak of smashing EPS estimates, which they've now beat by over 200% in Q3 of last year, 650% in Q4, 82% in Q1 of this year, and another close to 100% beat in Q2 as well. So I don't know what's going on with Wall Street. I don't know why they're expecting so little, but management there, I think, is just doing an absolutely phenomenal job of of putting up good performance and smashing estimates. And year over year numbers were just as impressive, with revenue soaring 43%, while net income skyrocketed by 125% as well. Now, if you don't know much about this company, Duolingo is the world's most used learning app that primarily teaches you a new language, although they're also expanding into math and sciences too. But by combining a free or at least very cheap learning app with fun games and progress trackers, Duolingo has managed to capture a giant audience, becoming the #1 most downloaded education app in the world at over 500 million total users, where they teach over 100 different languages. And thanks to all of the advancements in artificial intelligence lately, Duolingo has also used AI to power their more premium super service, which is helping accelerate adoption and growth. As a result, even their free cash flow more than tripled in the quarter, with monthly active users also rising 50% and paid subscribers also growing by almost 60% as well. And there's still probably a lot more growth to be had in the future too, as they expand further into more subjects, more schools, and even the workplace, where corporations can pay them to teach their employees new languages as a team. Surprisingly though, despite the massive quarter, Duolingo stock was about flat for the week, and in my opinion, it had almost entirely to do with how much the stock has already ran up this year, having nearly doubled and mostly recovered from the previous crash where I did most of my buying. Now, I've made many videos about how cheap the stock was back then and why I was buying so much of it at that time, but after the recent climb, you're talking about a pretty rich valuation here at a price to sales of over 13 now. However, the reason why I continue to hold my shares long term is because I just think that they're going to eventually benefit from huge software like profits. But at the moment, the company is still technically not GAAP profitable, so it's definitely not the right fit for everyone. It's still a riskier spec stock and it should be treated as such, but I remain bullish on this one long term because I just really like the business and the stock. Anyway, that'll bring us over to Wednesday now, where we had the giant media company Disney report, ticker symbol DIS, who's, as a lot of you know, they've been going through a bit of controversy lately, but just looking at the stock itself, it's been heavily beaten down at this point, with this week's earnings also being a bit of a mixed bag, as they had a solid beat on EPS but a slight miss on revenue. And while they did grow sales year over year, it was only by about 4%, and more importantly, they took a 132% hit on net income, although operating income was actually up by a double-digit percent at around 12% gains. Now, the hit on net income appears to mostly be from restructuring and impairment charges, which are not too big of a concern long term, but when breaking down the segments, we can see that the media and entertainment segment continues to struggle the most, with another decline here of 1% on revenue and 18% on operating income, which is heavily being impacted by the current writers and actors strike going on in Hollywood. However, that was mostly offset by better performance in their theme parks and resorts division, which had opposite performance. Direct-to-consumer revenue was also up 9%, with losses being cut in half year over year, so that was a positive sign for their streaming business, which is, obviously where the company is moving their focus to long term. And that was also boosted by a recent price increase to Disney Plus and Hulu, which they also mentioned in the earnings call that they plan to raise prices even further in the future. Investors did worry about an increase to password sharing as prices go up, but Disney has also come out and said that they'll be cracking down on it, similarly to what Netflix recently started doing too. And overall, it appears that Wall Street liked these changes enough to raise the stock price by about 3% for the week. I'm personally torn on the changes myself though, especially as a consumer, because I hate how expensive these services are getting now. So I just kind of started cycling between them. Like, I'll have Disney Plus for a couple months, then I'll switch to Netflix for a couple months, then I'll switch to HBO Max, then Hulu, and then back around. I'll just kind of keep cycling around like that so that I can watch all the new content from each platform, but I only have to pay for one or two at a time. But long term, I do still think that consumers will be willing to pay for these services. I mean, I remember the days when everyone had cable TV and that was like $50 to $100 a month. So I still think that streaming is a much better value long term. But in the short term, I just think there will be a little bit of pushback until consumers get more used to it. Either way though, Disney stock as a whole is now down over half its value from the top, and while I acknowledge that they do have some social and political controversies going on, and they're also being affected by the current writer strike, I just think that this is too powerful of a media company, really the biggest in the world in my opinion in terms of brands and value, for it to be trading this low. So I'm still buying the stock for a long-term position. Alright guys, we're running low on time here, but let's just finish up with a quick update on Alibaba stock, ticker symbol BABA, who reported on Thursday, and they initially saw a big spike of almost 5% that day, but then quickly corrected back down to still finish the week in the red. And we'll come back to the stock chart here in just a second, but looking at the report, I think it was an absolute monster of a report, as they not only beat on sales, but they also beat on EPS by over 20%, while also growing their revenue by 14%, their net income by over 50%, and their operating income by almost 80% year over year. So that's very strong performance. That's despite this already being the largest e-commerce retailer in China at almost half the entire market, while also controlling the most Asian cloud computing market share as well. And they also have the fourth most market share in the entire world, only behind other giants like Amazon, Microsoft, and Google. So they're giants. So, for them to still be growing by this much at that size, in my opinion, that's a clear sign that their post-pandemic recovery has already started. And on top of that, it looks like their recent efforts to lower regulatory exposure and hurdles and increase their overall efficiency by restructuring the company into 6 different subgroups is also paying off, as the weakest one in the quarter was probably their digital media and entertainment group that only slightly grew sales, but it still managed to improve losses by almost 50%. Cloud only grew sales by 4%, but still more than doubled its profits. And then all the rest were absolutely on fire, with the Chinese retail group growing sales by 12%, local services grew by 30%, smart logistics grew by 34%, and the super important international e-commerce group that includes Lazada and AliExpress grew their sales by over 40% as well. So just a monstrous quarter overall. So why then did the stock actually decline for the week? Well, I think Chinese stocks in general are still facing a lot of pressure right now because of the struggling Chinese macroeconomy, as well as an executive order that was signed this week by US President Biden that cracks down harder on companies building technology for the Chinese military. But overall, you're talking about a stock here that has now fallen by over 70% from the top. And as risky as Chinese stocks are, I just think anywhere under $100 for Alibaba is worth picking up from a risk-reward perspective. I mean, the valuation is dirt cheap now, with a forward PE of just 10 and a PEG of only 0.5, which are more than 30% and 60% cheaper than the sector respectively. So while I understand the risk, and trust me, I actually think that most people should not be buying Chinese stocks because they don't understand the risk that they carry. They could end up losing a lot of money on them and then panicking and freaking out. I think they'd be better off just avoiding the headache altogether and sticking with safer stocks. But for me personally, I understand the risk that I'm taking here. I'm okay with losing some money on these investments if things go south. And when I look at the risk-reward profile, I just think that it's worth it for me. And I'm only investing a small amount in Chinese stocks. I actually limit my exposure to them to try to mitigate some of that risk. But if things end up working out long term, if the US and China actually get along, if the VIE structure doesn't screw me over, and if other risk factors don't occur, well, I could actually end up making some very big profit multiples on my investments here at these prices because they are so incredibly cheap, even with the small amounts that I'm investing. So that's why I still invest in Chinese stocks, but that's just me, guys. Don't just copy me. Do your own research and make your own decisions. I'm never telling you what to do. Do your own research out there, make your own decisions. But anyway, I hope that you enjoyed the video regardless. I hope that you enjoyed this week's update, and make sure you tune into next weekend's update because we still have more big popular stocks reporting, especially in retail this upcoming week, including some giants like Walmart, Target, Home Depot, JD.com, and more. So you won't want to miss it. Make sure you're subscribed. Thanks again for stopping by, my friends. I really appreciate all your support, and I will catch you in the next video. Take care, everybody. Bye-bye.